Hello and welcome back to the Note. It's been a relatively difficult day for stock markets today across the world. That's largely due to the troubled situation over the Greek debt negotiations. Elsewhere, relative calm, which gives us an opportunity to take a look at earnings. Easily ignored, but they tell us a lot of very important things now that the fourth quarter earnings season for the US is well advanced, as now is also the earnings season in Europe. Perhaps the single most important point to make is that if you exclude energy, and we know what the problem was there, this has actually been a very strong earnings quarter in the US. 9.9% year-on-year growth, according to Thomson Reuters, excluding energy. However, the bad news is that that is continuing to be almost entirely driven by margins. For the 14th quarter in a row, profits have risen more than revenues. Revenue growth continues to be disappointing. Meanwhile, in Europe, if you exclude banks, which have growth distorted by dramatic losses taken a year earlier, then earnings look as though they're going to be down some 4% year on year, as will also be revenues down by some 2%. Still very disappointing numbers coming out of Europe. Now let's focus on revenues. This is how the changes in revenue break down sector by sector, according to Thomson Reuters. And you can see that the US dominance is really about two sectors in particular, which are healthcare and technology. They have really grown in a way that other sectors haven't, and in a way that their counterparts in the rest of the world have not been able to. Beyond that, you can see obvious signs of weakness in Europe. And I'd like to make two other points. First of all, there is still very little sign in aggregate that the strong dollar is affecting US companies' revenues. It's blamed as a problem by those that have disappointed, but in aggregate it does not appear to be an issue. Secondly, there does appear to be a little evidence, if you look at the strength of revenues from consumer discretionaries and industrials, there does seem to be a little evidence that the cheaper oil price is beginning to help companies that benefit from it, in the same way that it's obviously already hurting the energy companies themselves. But the final point I'd like to make is, given that this has been actually quite a strong earnings season in the US, it becomes all the more concerning that the market here in the US is actually still down very slightly for the year. That tends to confirm that the market entered this year very seriously overpriced.